This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome back to Bank Nerd Corner, everybody's favorite Bank Nerd podcast, the only Bank Nerd podcast, the best Bank Nerd podcast.
I think we destroyed the other ones.
I think we have to.
In between last episode and this one.
Yes, anyone who is trying to take our throne, you have one shot, but you better not miss, because this is the Bank Nerd podcast. As you just heard, I am joined, as always, by the delightful Kiah Haslett. Kiah, how are you?
Good. The cicadas are mostly gone in Tennessee, so I once again have peace when I walk outside and no flying giant bug risks running into you or gets stuck in your hair, which is what was happening the last couple of weeks.
Really? I guess we haven't really talked about that. The delightful thing about living in Montana is it's too dry and cold for 99% of bugs. And so my adventures with insects are very limited, thankfully.
Do you have you have mosquitoes, right?
Not really. It's too dry.
See, yeah, that's
we
crazy.
have nothing. Yeah, we have no mosquitoes. We have no beetles. We have no ticks. We haven't had any cicadas. I know it's a huge problem, but that has not been an issue. So they're loud and getting in your hair. That sounds horrible.
They're really loud. They fly around and they're really big. And I guess they have no survival instinct because they'll just run into you.
Oh, wow.
And they like to hang out on stuff. They like to sit on stuff. And so they're not trying to get off of you.
Right.
Either. And they're not really walking around or anything.
They just want to be your best friend.
Yeah, they're really dumb. And if a tree is being really loud, if you're outside and there's just a really loud tree, you can look up and they'll just be crawling all over the trunk. And it's so gross.
That does not sound good at all.
And so they also, when they emerge, they all shed their exoskeleton. So they're just exoskeletons everywhere on the ground. And then now that they're all dying, I guess, they're also just tons and tons of bugs on the ground. But I think we're at the end. I think we're at the end of hell. So I think hell is almost over. I think they're about to crawl back into the ground for 13 to 17 years. So
this honestly sounds biblical. It really, really does what you're describing. I don't want any piece of this. I wasn't intending the beginning of this podcast to be a anti-tourism commercial for Tennessee and a pro-tourism commercial for Montana, but that is where we ended up. I will say that it is actually entering beautiful weather season. So while I like to joke that no one should ever move to Montana because it's horrific 12 months of the year, this is the 1 month of the year, June, where I have to make an exception to that. It is absolutely gorgeous. I might not even record any more podcasts for the next couple of weeks. It's amazing.
You'll just go outside. I remember when we were recording with Professor Julie Hill that you guys were talking about there being snow on the ground.
Yeah,
that was 1 month ago. So I can't hang with that either. So
no. I mean, that's what drives all the bugs, including the hideous cicadas, away from us, I suppose. But snow is mostly gone. I'm looking in the mountains right now. There's a little snow up there, but down in the valley, it's all very sunny and supposed to have beautiful weather. I built my kids a trampoline this weekend.
Whoa.
That was my big project. My in-laws, as they're wont to do, and I don't think they listen to this podcast, so that's fine. They just send stuff to our house. They just order stuff and it just shows up. And so these big boxes showed up and we were like, what the hell is this? And they're like, oh, we got him a trampoline. We thought that'd be fun. And my wife in particular thinks trampolines are death traps. And so
they kind of are.
And so she was like, I'm not wild about this. And I was like, look, if there's a trampoline in my garage just not being built, I'm going to build the trampoline. And so we have the trampoline. It has gone well so far. No injuries. Good. And in fact, the baby, who's now 1, it's actually a wonderful baby containment device because they have these nets. And so you just sort of zip her into it and she kind of crawls around and bounces around. And I know exactly where she is and she's safe. So kind of wonderful, really.
Yeah, I didn't realize trampolines were baby, what do they call it? Playpens?
Yeah. It's an elevated, off the ground, really fun, bouncy playpen. So little parenting hack for those out there.
Really expensive parenting hack, a little dangerous when the baby is more mobile, but
Right. But until we get to the broken arms and me throwing out my back, it's been delightful. So we're gonna take that sort of bouncy, fun trampoline energy into Bank Nerd Corner. As always, listeners, we have some Bank Nerd stories to hit. So Kiah and I are gonna take turns swapping stories that we want to talk about, and then as always, we will try to unpack a question that is sort of confusing us and try to answer that, and then we'll see if we can carve out a little time at the end for Kiah. So Kiah, are you ready to go?
Yeah, let's do it.
All right, you take us off on our first story then.
Sure. So we have spoken about in previous episodes about cases before the Supreme Court that involve banks, and
Yes.
we are now in Supreme Court decision time. The Supreme Court came out recently with 2 decisions that impact banks. The first one was Cantero versus Bank of America. You are going to have to deal with 2 non-lawyers trying to figure this out for banks.
This is not legal advice, by the way, just so you know.
None of this is legal advice. And also, this is always my own opinion. But so in the Cantero case, Bank of America, there was like a rule that they needed to pay interest on escrow accounts for mortgages. And Bank of America, the rule was like a New York rule or something. And Bank of America said, we don't have to follow that rule because we are a nationally chartered bank. And there's not a national rule that says we have to do this. And so the issue at hand is what we call federal preemption, which is the idea that if there is a state law and a federal law that speak to the same issue and are in conflict, or the state law is more restrictive than the federal law, which law does the company have to follow? And for banks, this matters if you are like kind of a state chartered bank or a nationally chartered bank. Bank of America has a national charter from the OCC. And so the question was basically like, does Bank of America have to follow this state rule? Or can they just say, well, we have a federal charter, we don't have to follow it? And the Supreme Court came back and said, it depends. So it wasn't a straight yes and it wasn't straight no. But what they said was that there needs to be an analysis that when banks make this argument, courts need to analyze whether the state law significantly interferes with the national bank's exercise of its powers. If it does, the law is preempted. The bank can ignore it and follow federal law. But if the state law that the bank is being told to follow does not significantly interfere or prevent the bank from exercising its power, the law is not preempted. So this is not a straight win for either side, for either the state banking agency or the state government or the federal bank regulators. But I just thought it was interesting because I think these decisions about, or these conflicts about federal preemption, they kind of come up a lot in fintech when we think about like lending caps. Like different states have rules about what interest rate banks can charge. And the question is, can they place that rule on banks that are chartered in that state? Or can they do it, to banks that are federally chartered that operate in that state? And so this is kind of an area where fintechs might find themselves just like in the middle of a debate that maybe didn't appreciate or realize that stems from this idea of federal preemption. The other thing too is we might see more conflicts like this or more disputes like this because the head of the CSBS, which is the Conference of State Bank Supervisors, it's basically the group that helps coordinate the 50 state bank regulators and across, so they have similar examination priorities and similar training and education. So he's new. He said earlier that he wants the organization to be on more equal footing with their federal counterparts. I guess maybe the CSBS feels like they sometimes are like, I don't want to say like second fiddle to the national guys, but in our, federal, the dual banking system, that's, sometimes like the banks get their charters from the state. And so that is the agency whose rules they need to follow. So that's the first case. The second case is NRA versus Vullo. In this case, the conduct that was alleged is that Vullo, who is the head of the New York Department of Financial Services, so there was some insurance companies that were selling a product tied to like firearm usage that was just like inappropriate, like it was illegal. So the New York DFS says, do not do that, and that's illegal. And so these insurance companies paid a fine. And then the New York DFS was like, actually, we kind of think it's like bad if you provide banking services to the NRA. And we think, and they were talking to the banks that they supervise or other companies that provide services to the NRA, financial services to the NRA as a customer. They were like, we think that your association with the NRA could give you reputation risk. And the NRA found out about this and was like, hey, you are a bank regulator and you are like a member of the government. And this is an inappropriate use of speech. And this is like an inappropriate act of a government official to do that. And what I read about this case is like this kind of communication where the regulator is saying like, we kind of think it's like not a great idea, but it's not, they're not saying, hey, you're breaking a law. It's called jawboning, which is informal pressure that like an official would use to influence speech decisions or like, I guess, like business association decisions. And so in this case, they're basically like saying like the regulator needs to be careful about how they like communicate. So The Supreme Court found that the NRA's argument that like this was inappropriate and that their like ability to access financial services had been like they plausibly alleged that the superintendent of the New York DFS had violated their First Amendment right by coercing the regulated entities to terminate the business relationship. So this case is like a free speech case, but I think it's really interesting from what we would call reputation risk, which is how like that a bank might do something and that action or the fallout or consequences of that action would cause the public to lose esteem, and it would hurt the bank's reputation. And this kind of comes up like in how should a bank act? Who should a bank bank? It comes up when in ESG, which is the environmental, social, and governance considerations. It comes up with, some of these like relationships with, oil companies or firearm manufacturers. And the question I've been really interested in is like, how much should a regulator kind of care about any of these things outside of the financial impact, the safety and soundness impact, right? Is it really the regulator's job to care about a bank's reputation risk? Or is it really the bank's job or the board's job to care about reputation risk? And if a bank has decided a customer or a business line is worth the risk, is it appropriate for regulators to kind of weigh in on that and say, like, do you really want your reputation? Like, so I think that's kind of interesting. I think that's like a very interesting way to think about like, what is the role of regulators here? The other thing too is the NRA was like the client of a bank. It wasn't the bank itself that brought this case. So I think that's a little interesting too.
Yeah, I mean, it's fascinating. That was an excellent overview of those two cases, by the way.
Good non-lawyer overview.
Yeah, for not being a lawyer, that's pretty good. It is fascinating. The first case against Bank of America, I mean, that one, I'll be curious to see how that gets interpreted in future cases, obviously, because they didn't sort of decide one way or the other in all cases. It has to be this way or that way, which obviously I think probably... But the Supreme Court was probably the right way to go. But like when they say this is a function of like, does this significantly interfere with a national bank's exercise of its powers? But what does that mean exactly? Like what
your
what
ability to do your job.
Yeah. I mean, like one and like in a specific, like you were mentioning fintech and sort of lending caps and stuff. Like, does lending at a interest rate above the usury cap in a particular state, is that an example of a bank exercising its national bank powers? Would preventing them from doing that be significantly interfering with their ability to do that? I don't know. I have no idea.
I think they'd have to maybe argue, if one of those cases goes up to the Supreme Court, they would have to argue that it's their ability to price risk.
Right.
Maybe.
Right. No, I think that's right.
Like, you'd have to justify why do you need to charge this interest rate above 36%.
Yeah.
But this also comes up too with I've been really interested in like, how do you calculate or what's a loan? Because EWA can sometimes be, or earned wage access can sometimes be construed as a loan.
Yep.
Now, buy now, pay later is now being construed as a loan sometimes.
Yep.
And so there are states that maybe don't want to do buy now, pay later, or don't want to do earned wage access or certain types of loans. And, can they say, you can't do that kind of loan here. And then a bank is like, well, that significantly impacts our ability to exercise our powers or price our risk or serve customers who want, the bank's like, your state citizens want these products. Like, who are we to deny them these products? And is it in their best interest to do it?
Well, I think that last point you made is exactly the right one, right? Which is that, to me, there's a very big distinction between a bank exercising its own powers under the argument that like we're a business and these are our powers and we're going to exercise them to make money or profit, versus the argument of this is in the interest of your citizens, right? And like these people need these loans. Like, is it interfering with the bank's exercise of its powers to say, as a state, we don't want you to loan money to these consumers? Right? Like, if the choice is decline them for a loan or approve them at this interest rate, we would prefer that you decline them. And the bank says, well, we would prefer to serve them. Well, the bank is saying that partially because they can make money by serving them, but there's also an argument from a public policy perspective, and this, I imagine, would come into those cases, that, and this comes up a lot with regulation. The CFPB has been going through this with their proposal to cap late fees on credit cards. It's the same thing. Does this restrict access to credit? And if it does, is that a good thing net for the consumers, or is it a bad thing? And that is an incredibly tricky question. I mean, I would be very curious to see that play itself out in a legal context, because it really gets into like almost sort of a paternalistic question of, should you have this credit? Should you not have this credit? Are you being responsible with this credit? And so I think this could lead to a series of much more interesting follow-up cases where we start to get sort of a legal lens on some of these pretty sticky, difficult to answer questions. So that's very interesting to me. And then, NRA versus VULO, I mean, that one, I think actually when we were recording with Professor Julie Hill, which was a great podcast that people should go back and listen to, one of the things we talked about offline with her that we didn't end up including because we were so focused on vet master accounts was she also is pretty interested in this whole reputational risk area. And I'm curious about it too, because as you laid out, reputational risk is a very fuzzy area. And, like what creates reputational risk? I remember digging into this with cannabis actually, right? Where it was like, should you bank the cannabis industry? And it's like, well, it's, legal on a state level, so why not? And regulators are like, well, because, plausibly it might make certain people nervous. And if it made certain people nervous, maybe that would harm your reputation. And if that harmed your reputation sufficiently, then that might cause depositors to be nervous. And if depositors or investors were nervous, that might impact your safety and soundness. And so like you can draw a line from certain activities to safety and soundness via this like reputational risk bridge, but it's pretty tenuous and pretty uncertain. And I think a point that people who are critical of this bring up is, aren't banks, executives, and boards of directors better positioned to judge the reputational risk of going into a particular business area than regulators at a 30,000 foot level who don't have a good sense of the business or the relationship between the bank and its customers? Like, I think that's a very good argument to make. And in this particular case, I mean, it is kind of interesting that it was the NRA that took this to court rather than the bank acting on their behalf. But I definitely see a lot of room for legal pushback on this reputational risk. This feels like an area where regulators are maybe overstepping their bounds a bit.
Yeah. And it's interesting too, because, we talk a lot about like, what kind of banking industry do we want to have and who should get banking access and how should they get banking access? Yeah. I think one thing that's really interesting from maybe like a social perspective is the values that we ascribe to different institutions. So we know that, climate risk is being flagged by regulators in part because you can get losses from climate events, like credit losses from climate events. So there is like a financial risk there. So does it therefore follow that, climate risk is something that banks should consider from a reputational perspective? I also think what's interesting too is that some of these borrowers or some of these industries that might be good credit risks are not popular with certain parts of the population. Yeah. And so the question is like, if the person is good for the money and they're a good customer, does it matter that maybe our employees don't ideologically like this business? Or does it matter that this manufacturer has been tied to things that are bad in the news? Right. And if it doesn't impact their ability to pay back their loans, is this something that we as a bank should care about? And, I think that answer will be different for every single bank. But it's just really interesting too, because then it's like, and also different banks can have different risk tolerances. So it is really interesting to think about the regulator's role here.
Yeah, no, it really is. I mean, I totally agree with that. I think I come down on the side personally of this should be left to banks on an individual basis, right? Like it's a free market thing. I mean, capitalism, Kiah, this is me being pro-capitalism. You ready? Yeah. So pro-capitalism, Alex, I think would say that in this particular case, to your point, if there's a bank where they're like, look, we don't really want to bank the gun industry, the gun manufacturing industry. Fine. Like your employees aren't here for it. The executive team doesn't want to do it. That's fine. But like if enough other banks don't feel that way, or if a bunch of them do feel that way, there's going to be a market opportunity for someone to come in and get pretty good business, probably at better pricing by doing that. And capitalism will sort of sort that out. But at a regulatory level, absent Congress, who doesn't tend to do much, absent like a law prohibiting it, which is something that runs through sort of our regular democratic process, I'm not a big fan of regulators putting their fingers on the scale and going, we just don't think this entire industry should be banked. I mean, I tend to view banking from a regulatory perspective much more as a utility, which is to say, like, in the same way that...
Hot take.
yeah. In the same way that you have electricity or water, or even like, this sometimes comes up with like cloud computing, like, should AWS provide services to this industry or this industry, that kind of thing. I kind of think infrastructure at all of those different levels should sort of be available to everyone who can pay. And it's up to other people up the chain from that to determine which industries we allow and not. So anyway, I think this is overall probably a good development and probably something we're going to see more examples of pushback on. I do wonder a little bit if we always joke about, like, in fintech, like the era of zero interest rate policies, or I kind of wonder if like the ESG reputational risk pushing back on certain industries thing, like, I wonder if that was the regulatory equivalent of like a ZERP era phenomenon that we're kind of like coming out the other side of, because it does seem like it was concentrated during those same years. And now as practicality has sort of set back in, everyone's kind of like, let's just bank everyone who we're legally allowed to bank.
I do possible? Think like so what I would want to see from banks, maybe not from a reputation risk perspective, but is an encompassing of risk. So like with climate, even understanding how different climate events might impact your loan portfolio. And, we're seeing in a lot of these states, the like property and casualty, coverage, insurance coverage. And how does that change the risk calculus that you would make from a bank? I don't know. I really struggle I'm kind of cynical about reputation risk. I kind of don't think it exists. I think it's like a boogeyman you can point to as like, what if something bad happens and then people judge you for it? And it's like, I'd probably be more concerned about the bad thing happening versus the judgment. But the one time I really think reputation risk was very salient in the banking industry is the Wells Fargo fake account scandal. There were not that many actual losses. I'm just going to go ahead and say that there was not that many financial harm. Relative to other things that can happen. Opening accounts in someone's name is not the worst thing you can do to them financially. And so it was kind of this like really weird scandal, but people lost a lot of trust, and as they should. Their information was fraudulently used by an employee, misused for reasons that had nothing to do with the betterment of the customer. And that's like the biggest reputational risk I can remember a bank taking that was separate and apart from the fines that regulators assess to them, right? Like Wells Fargo has like kind of a bad reputation in some parts of the consumer industry. I know at least one person who closed their account over this.
I do too.
And so it's not like, and maybe they didn't lose like a bunch of money from either of these accounts closing, but that's like the one time where I can think of like where reputation risk was very salient, but the financial and the earnings risk was not. Legal risk was high, regulation risk was high there. But as far as like actually taking losses on this outside of the fines, they didn't really do it. So that's the one time and I don't know how many of those we'll have, right? Where it's just reputation risk. And
you and I have talked about this too, right? Like reputation risk is always attached to something else that gives you a better mechanism to punish that behavior, right? They committed fraud. Incentives. That's the problem, right? Like they committed fraud against their customers. You don't have to go after them over reputational risk. Just go after them after fraud, right? Like I think that, to your point, reputational risk gives regulators a lot of latitude when they otherwise wouldn't have it to curb things they don't like. But when there's something that actually does genuinely create a reputational risk, there's always another avenue to police that behavior. And so I just don't, it doesn't allow for us to solve problems that should be solved. It gives regulators latitude to solve problems that they probably shouldn't be weighing in on themselves, would be my take.
Okay, honestly, that's a perfect segue to the next section about reputation risk and a different separate risk.
It is.
So, Alex, did you see this blog post from the CFPB about their decision to file an amicus brief in the New York courts for a case involving Citibank?
I did. Can I run you through what I read about it?
Yeah, tell me about it.
Okay, so basically there is this sort of case that's happening right now between New York regulators and Citibank, where essentially the state of New York is alleging that there are a set of customers at Citibank who have been losing money to scammers. In one particular case, they alleged that a person discovered that a scammer had changed her online banking password at Citibank, transferred money from her savings account to her checking account, and then stole $40,000 out of her checking account. So ordinarily, the way that you as a consumer would deal with this is that you would notify your bank. And as long as you notified your bank within a certain time period, and as long as this was not a transfer that you authorized yourself, which is sort of its own whole can of worms. That's where Zelle and a lot of the scams that we see there, that's where the problem enters in there is if you authorize the specific transaction, the bank is not necessarily liable. But in this particular case, sounds like what the state of New York is alleging is that these were not authorized transfers. However, they were being made by wire transfer. So rather than the transfer being made via, I don't know, ACH, I suppose, these were a $40,000 transfer being made by wire transfer. And so while the customer notified Citibank of this, and I think in notifying them wanted the sort of associated protections that you get under this circumstance, under the Electronic Fund Transfer Act, or EFTA, Citibank apparently decided not to sort of consider those protections to be in place because, and this is the part I'm a little fuzzy on, they were looking at a law that was intended to govern transactions between commercial entities. So I suppose if it's a wire transfer is the mechanism that's used to transfer money out, it's considered a transaction between commercial entities, which does not provide the same level of consumer protection to victims of scams. So Citibank has argued that the EFTA does not apply because the scammers used a wire transfer to take the money, and the act contains an exception for those transfers made by means of a wire service.
So like when the law was written, it was like only companies would use a wire.
Correct. If it was like a transfer between companies. And so the original law gave a very narrow exception to transfers made by means of a wire service, because I guess at that time, consumers weren't making wire transfers. It wasn't even a service that was available to consumers, and so the law essentially did not sort of envision a scenario where a consumer, particularly through an online context, obviously, could connect their checking account to a wire service and transfer money out. Now, obviously, a lot of modern deposit accounts have wire transfer services.
Yeah.
I don't tend to use them a lot. I know you don't either, Kiah.
Not
some of our friends
payments.
Yeah, like some of our friends in like the VC tech community, I think, make a lot more wire transfers.
Apparently, everyone who banks at Mercury really need like the Mercury personal banking account. Really needs free wire transfers, right? All the SVB types that personal banking there, they all need wire transfers coming out of their checking accounts. Like
I wish I had the problem of having a ton of extra money sitting in my checking account that I needed to write like angel investments for. I don't, and so I don't write a lot of
maybe for like college
investments.
Or like because this doesn't even happen for like down payments, right? You don't, or is it like a down payment the only time you would ever have this kind of transaction?
I think it's pretty rare, and I think the virtue of a wire transfer is that it is immediate and you can do very large dollar amounts, but it costs more, right? Which is why most people don't do it most of the time. And it's usually subject to a lot of fraud checks, which is the other question I would have. The one time I made a wire transfer from my bank, I got about 6 calls from various people in my bank asking me, double checking, finding out the reasons I was saying, like it tends to run through a pretty rigorous process, which is one of the reasons I'm a little confused in this Citibank case. Like, where was the sort of fraud checks associated with just making a wire transfer? Even if a scammer had gotten access to someone's accounts, normally the bank goes through quite a bit of work to do due diligence before a wire transfer goes out. Anyway, the end result was the customer did not get their money back from the bank because the bank was making this argument. As you enumerated, the CFPB decided to weigh in on this via blog post and via an amicus brief in this case that the New York regulators have brought against Citibank, basically arguing that if you are connecting a online banking account to a wire service, then by virtue of the fact that you are likely transferring money into that account via ACH, which is covered under EFTA, then any transfers made out, even if it's by wire service, are subject to consumer protections under EFTA. The trade groups, trade associations hate this interpretation, which you might be surprised to hear. I know. In a joint statement, the ABA, BPI, NYBA, which I believe is the New York Bank Association, and then TCH, which is the clearinghouse, wrote in a joint statement that the CFPB has the law wrong here. Wire transfers are excluded from the EFTA. The CFPB cannot reinterpret a statute and reverse decades of settled law in an amicus brief, and then use a blog post to suggest that its position is the law. The Bureau is supposed to be educating consumers, not confusing them. spicy stuff from the ABA, BPI, NYBA, and TCH. So
I consider myself educated that I did not realize that my bank, which gives me wire transfers, would consider this an uncovered transaction. Like, why are you giving it to me then?
That's exactly my thing.
This is crazy.
Right.
I'm learning so many things.
I am learning too, right? I mean, two relatively educated banking consumers did not know this. So I have to say, generally speaking, that I am getting really sick of banks using every loophole available to them around the EFTA, right? So to your point, they give us wire transfers. They're like, here, this is going to be great. You'll love wire transfers. If you have to make a big, payment really quickly, this is a great option. We'll connect it right to your checking account. We'll make it easy to do. Apparently, we won't even really check too much if you decide to make a wire transfer. Here are real-time payment tools like Zelle. The money moves instantly. You can pay your rent overnight. It's going to be great. They give us all these tools connected to our checking accounts. And then as soon as something happens, which again, like we're constantly being attacked by fraudsters, people are trying to trick us into authorizing transactions that we shouldn't be authorizing. They're apparently getting access to our checking or savings accounts and then initiating wire transfers without our knowledge. All of these are things that they are able to do part and parcel because banks have wrapped really strong payment capabilities around our checking accounts. So they want all the benefits of giving us all of these tools. And then when it comes time to be like, oh yeah, that was a scammer who was doing that, then they find all these loopholes to get out of doing that. That doesn't work for me. I'm not a huge fan of that. I think this is really, really bad. And I got to say that, like, as we're entering this world of, oh, maybe pay by bank is going to take off, merchants really like it. Many banks can come up with like entirely new payment rails that use, ACH or I don't know, wires or use FedNow to like transfer money. Like, let's create new consumer experiences around payment rails that aren't running on the card networks. Okay, that's fine. I'm totally fine with that. But you know what the card networks have figured out? They have figured out how to protect consumers. Like, they don't put up with this shit, right? Like, if there is any problem associated with using a card, Visa and MasterCard basically tell issuers, like, figure it out. But under no circumstances are we going to allow consumers to get ripped off using our cards. Like, it is always going to be to the benefit of consumers unless you can demonstrably prove that the consumer is committing fraud. Otherwise, make them whole and let's move on. That's why people trust credit cards and debit cards as a payment rail. That's why people trust Visa and MasterCard. And if you're not going to put those same protections in place, if you're not going to volunteer to assertively and expansively interpret the EFTA as a way to protect your consumers when they're interacting with these tools you're giving them, no one is going to trust you. And that is a problem for you. Yeah. So I am super, super frustrated about learning about this case and how Citibank is interpreting it. And while I have some qualms with the way the CFPB is sort of weighing in on this that we can talk about, in general, in spirit, I'm totally with them. What do you think?
Well, I think I'm with you in that I do not think banks arguing that their customers are stupid is going to be like a winning, when it comes to scams and fraud, is going to be a winning long-term strategy. I think an expansiveness of the understanding of how do scams happen, how do frauds happen, and then some, like, the other thing I always really struggle with, and people on Twitter seem to disagree with me on this, if a scammer transfers money from one bank to another bank, the second and receiving bank has participated and facilitated in a crime. Like, totally. You have received stolen money.
Well, and here's the thing about that I'm so confused about. It relates to exactly what you're saying. Yeah. Like, Zelle's a good example of this. Why can't Bank A just go to Bank B and go, hey, give me the money back? Like, just give me the money. Like, what the hell?
That person is also, not only give me that money back, that account is receiving stolen funds. It is probably not just from me.
Yes.
And the Bank B, I would want to see some very serious, oh my God, here's the stolen money back.
Yes.
Shut down the account. We are pursuing criminal actions against this person because
we're going to do a forensic analysis of all of the, like, we're going to know all the IP addresses they've used to access this account. We're going to share all that data with all these other banks. Like, this person who's been using these two banks to commit money laundering, just like you're saying, to commit a financial crime, they're getting excluded from our system. And it seems like banks are just not, like, Bank A isn't willing to have that conversation with Bank B, and so the customer gets screwed. It's really weird.
And the other thing, too, is I also think that when some of these laws were written, the financial system that existed at the time, it's just not really a relevant world anymore. It's not the world that we live
Totally.
in. And so when we're talking about this, like, oh, wires used to be only for companies. Okay, I can believe that. That's not the world we live in today.
It's not.
And so it does make sense to me that someone could interpret this law in a way that makes it more expansive so that wires just become covered. And I get that, like, again, these are trade groups. They're not banks.
Yeah.
The banks are behind the trade groups, whatever. So to say that, like, hey, this is actually the world we live in now. I would not die on the hill of narrowly written regulation from the 80s. I didn't imagine this. Like, what's the, when we think about like reputation risk, when we think about financial risk, like, is that really going to be your legal argument that this really old time law that didn't even include certain types of payment types because they didn't exist at the time? Like, or are we really thinking like, what is the spirit of this law? What is it trying to do? What behavior is it trying to protect and address? And if we were going to comply, and this comes up in soccer refereeing a lot, like, what's the letter of the law saying? What's the spirit of the law? What is the law actually trying to achieve?
Yes.
And so to say, what is the spirit of these laws and how would we comply with what the spirit of the law is? If this law is going to be written today and cover this, what would it mean for us? It means probably making that customer whole, potentially.
Yeah.
And that should be on the table. And then to say, hey, that really sucks that customer, how did that person even get all of their money stolen? How did that person enter our system?
Yes.
How did our checks fail? Like, what would it mean if we wanted to stamp out this behavior rather than if we were like, hey, sorry, we just banked a dumb customer and they just gave their credentials away and then we did nothing about it because they gave their credentials away, and who are we to stop them from giving their credentials away?
One, and here's the other thing. So Citibank might sort of say in this hypothetical argument, well, like, yeah, like, we're not in the business of being overly paternalistic about how our customers use our different services, blah, 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 blah. If Citibank cared about its customers, what they would do is you would be signing up for a checking account in the savings account at Citibank. And during the onboarding process, they would run through a list of features that they have for the account. And they would go, hey, so which of these features would you like to enable? And which of these features would you like to disable as we're onboarding this account and create this account for you? And wire transfers will be one of the features. And they would go, hey, so just so you know, when you click this button and you enable wire transfers, if for whatever reason a transfer is made from this account using this functionality that you're clicking a button and opting in and enabling, we are not going to cover any fraudulent transactions that go out via wire transfers because of EFTA, blah, 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 blah. Do you want to enable this? And if someone clicks affirmatively yes and says, I want to enable this and I fully understand the risks of what you're telling me, then it's fine. Then it's like, okay, you warned the customer, you gave them an explicit notice that this was going to happen. That's a different kettle of fish. I can guarantee you that Citibank doesn't do that. What they do is you sign up for a checking account. It's low friction. They don't want to throw a bunch of stuff in your way. Yeah, come on in. All the features are enabled. It's going to be great. We have this really powerful account. They just give you all these tools and they don't warn you that some of these tools are a little bit more dangerous than others, A. And B, if you hurt yourself with one of these dangerous tools, we won't help you. Like, if you don't give customers the heads up on that in advance, and then you exploit the loophole to not help them on the back end when the thing goes wrong, that's on you. And so, like, to me, again, there's multiple ways to solve it, either the front end or the back end, but it really does speak to, and, I mean, banks complain all the time about, like, well, fintechs and, like, why are we losing ground to fintech companies, or why do people prefer working with fintech companies, or even community banks or credit unions or whatever. This is a good example of that, right? Like, in this one example that the state of New York cites, it's $40,000. You're Citibank. Just make her whole. What are you doing? What are you doing? Like, it's a very strange prioritization to narrowly interpret this thing to your financial benefit, rather than to look at it in a big picture sense and go, we want to be good stewards of our customers' money. And that lack of sort of long-term view and customer-centric view, and it's not uncommon in banking at all. We see it all the time, but it's a good example of why competition is good and why, like, I'm actually not too mad about the CFPB weighing in on it, even though, and Kiah, I just want to mention this briefly, I have to say, I am finding it strange. And I've seen this not just from the CFPB, but I think the FDIC did this recently. It's a little weird to see federal regulatory agencies weighing in on cases that don't involve them via amicus briefs. I don't know that I've seen that a lot in the past, but it's strange.
Well, okay, so I will say that, like, it is interesting because if we're, like, discussing whether a rule should be interpreted one way or another way.
And a federal law, by
rules,
the way, too. Yeah,
people who enforce the rules to like kind of weigh in. On your FDIC thing, I will say that like the FDIC weighed in because it was their memo that was being cited. And so the FDIC was like, fair. Oh, no, you don't get like, so it was like a group that was basically saying like, we're allowed to do this because the FDIC says we're allowed to do it.
Anytime you say the FDIC's name, their head pops up and they're like, you're saying, what about us?
And like, I think that's reasonable, right? Totally. You're basically citing the FDIC in a document. So the FDIC is like, well, what did you say we said?
Right,
and if you say something that the FDIC does not think it says, I think it's reasonable for the FDIC to say that because they're just entered into the record. So it is hard because it's like, we're just defining stuff and who gets to define different things and whose weight carries the day? Is it the trade groups or is it a bank regulator?
Well, and I mean, to use a completely off the walls analogy, but it relates to your soccer refereeing point. I mean, I'm deep in watching the NBA playoffs because my Boston Celtics are still alive and they're playing in the finals, which is very exciting. They will, when there's a controversial call that's being reviewed or something, they'll bring in like an ex-ref to like kind of comment on it at the time. It's not totally dissimilar to that where it's like, hey, like if the subject of consumer protections due to federal laws is coming up, the CFPB has a valid perspective on that they could add to the case. So it's not so much that I think it's a bad idea. It just seems like a new thing that's happening more. Mm-hmm. Probably a good idea, but it is sort of a new behavior that I could see annoying the bank traders. So that does make sense. Kiah, switching gears a little bit, I think we have time for one last story before we get to our question and our rant. There was an academic paper that came out that I think you wanted to talk about. Why don't you give us your report card?
Yeah, I'm going to try to do this really quickly because Alex does have a hard stop. I'm not allowed to just drag this.
We can't just go on and on and on. That's right.
So we did, obviously we've talked to death about Silicon Valley Bank and how bank runs happen. And one of the things that I think came up is that this run happened so fast, it feels like there's almost no data that anyone was looking at. And so we know that the bank had basically about $100 billion either about to leave or going to leave. And so since then, we've talked about, what are some signals? Is it Twitter? Is it stock prices? And those are not directly tied to deposits, and they can be really hyperbolic or noisy. The New York Fed came out with a paper that used high-frequency interbank payments data, so FedWire and then the Fed ACH, to trace deposit flows for between March 9th and March 14th. Across, they used their system, and they identified as part of that 22 banks that suffered a run during that period, which was significantly more than the 2 that failed. It's less than the amount of banks that were having negative stock price returns during that period. And they also looked at kind of the nature of the transfers, and they identified that they were large institutional depositors rather than a retail run. I don't know if that result is super surprising, but it is really interesting to have this data set. So obviously this data exists. The Fed uses it to settle payments, but I think it's pretty smart to think about it from what does it tell us about right now? And this data is available on a daily basis versus, what we would get with the quarterly call report. And so, I hope that the Fed and the board in DC and maybe the FDIC is starting to get copies of this data, reports of this data, so that in real time, they can look at banks that are experiencing high, liquidity events. Yep. And they can maybe start putting teams into place or emergency lending into place to help these banks withstand a run, or ask them hey, what are you going to do? Do you think you're going to fail, basically? So the Fed got to look at basically where the money was transferred out of and where it was transferred to. The banks that it was transferred out of tended to be 100 billion to 250 billion. They had significantly lower cash holdings and capital ratios than similar banks. They relied more on uninsured deposits, and these might have been the accounts that were moving. They were publicly traded. So being publicly traded was a big determinant of if you were a bank that was experiencing one of these secret runs. They, did an analysis of banks that I guess were maybe similar in some of the financials, but weren't publicly traded. And they found that those banks did not experience runs. And then the banks that received this funds were banks with more than $250 billion in assets. The paper points out, and I hadn't fully thought about this, but that these banks that are receiving the deposits, that are likely receiving deposits that are higher in volume than historic activity would indicate, this is essentially non-public information, and is one of the first signs externally that a run is happening. So if you think about a bunch of deposits left SVB and got transferred to Chase, or a bunch of deposits left Signature and were transferred to Chase. Chase might be one of the first banks that knows this is happening, right? Especially if you think about Signature, like Signature is kind of a surprise failure. And if Chase is seeing that deposit activity, they might know that this is happening. Maybe First Republic, right? Maybe Chase is like, oh, we know a lot of deposits are coming from First Republic. And then, so what did banks do to survive a run? It won't surprise you. They did not sell their unrealized or their AFS securities for unrealized losses to shore up liquidity. They ended up borrowing a bunch. They were preferred in this period of time, which does include the creation of the BFTP. They still preferred to borrow from the FHLB. I don't know if that's a matter of pre-positioning the collateral or if it's just, they don't want to signal to their regulator that they're experiencing a run. They tended to overcompensate. They brought in more liquidity than left. And then they would go on in subsequent months to try to bring back liquidity to them. And they used higher rates. By June 2023, most of the funding that they had lost had come back. So I thought that was really interesting. I hope that this data set and this approach is used in subsequent supervisory situations. I think I was kind of wondering what data does the regulators have that indicates where they need to be paying attention to. Yeah. And as likely is the data set. And I also think that sometimes transfer data or bank payment data is a little underappreciated on the bank side. Where does your customer's money go? And if you had a customer who considered your bank primary and then they have decided to change banks, how would you know that they're leaving this relationship? And are you looking at the data that you're receiving about their payment flows versus historical trends that would indicate that this relationship is changing? And this is kind of that analysis on a way bigger scale, right? When does a bank know it's experiencing a deposit run and how fast does it get that information? How fast are they able to substitute the funding?
First of all, this would seem to at least somewhat put to bed the argument that retail, Twitter, social media, stock price, blah, blah, blah is what drives runs, right? I mean, it seems like the analysis pretty clearly indicates that institutions that have an information advantage of non-public information about their banks, they're the ones that drive this behavior in large part. And, I think you could say in the case of a Silicon Valley bank that those institutions were probably sort of retail-esque in that they were prominent VCs or founders or whatever. But fundamentally, particularly when you get to slightly less specialized banks, the distinction between your retail base and your sort of more institutional base of depositors, that distinction becomes a lot clearer, and it's always more on the institution side. So that I think intuitively makes sense. And it's good that we have data that sort of supports that idea.
Right.
Your point about the data set itself is fascinating to me, though, because one of the things I am just sort of shocked by the more I learn about how all this stuff works is it's weird how both banks and regulators rely on a combination of sort of historical assumptions, supervisory activities, so exams and, all that kind of stuff, and sort of lagging data that's reported in, as you and I have talked about, not always the most helpful formats. It's strange that in the age of, digital technology, when we have all of these systems, we have APIs and, we have the Federal Reserve that is a massive payments provider that has all this infrastructure and a lot of the data is actually flowing through their systems. It's strange that we don't have a more, I guess you could say, real-time monitoring approach to doing this work, right? Because all the data is there. And I've thought for a long time, even when it relates to things like banking as a service and stuff, just, I think I've talked about this on other podcasts as sort of open banking for regulators, right? Why do we not have a system in which, the regulators can go to banks and say, look, we want you to connect these various systems to our system so that we can get a real-time view of the data for what's happening to your bank. If you do this, we will sort of put you under this other sort of regime from a supervisory standpoint, where your exams are going to be easier. We're going to have all the data we need. It's going to be less onerous. There's going to be less work, less expense for you. And the benefit to us and to you and to the larger system is we will get a real-time view into what's happening at your bank so that, if there's a bank run, we will get a quicker indication of that. And not only that, but to your point, Kiah, about when do banks realize this? then they have a problem versus when does like regulators realize this? I think the other benefit to it would be regulators could see across banks if there's a pattern to where this is happening, right? So to your point about where these deposit runs happened, they were concentrated within a particular segment of the market. And clearly there was some non-public information that was going around, and these large institutions were sort of drawing points of comparison across a different subset of banks. It would have been great for regulators to have like real-time or close to real-time insight into, hey, not only is this happening at these banks, but this is what these banks have in common. We should try to get ahead of this problem. And this is not something that's infeasible with the technology that we have and the systems that we have. It just seems like historically it's not how we've done it. And so anyway, I'm with you. I think it'd be really cool if this could become a model, not just for how we analyze how this stuff happens with the benefit of hindsight, but maybe how we get ahead of some of these problems in the future. I think the other thing that occurs to me just real quickly before we move on is this does definitely continue to support this idea. And you hear it from like regional bank CEOs whenever they talk on earnings calls. This is why we need to become bigger. Like, this is why we need to become a SIFI. This is why we need to gobble up other banks. This is why we need to be allowed to do more mergers. We don't want to be the banks that deposits
are pulled from. We want to be the banks that the deposits go to.
Yeah. I think it was Bill Damchak at PNC was talking about this, and they were asking him about sort of the last crisis. And he kind of said something to the effect of like, we were very narrowly winners net in the last one that we went through. Mm-hmm. We don't know that we can count on that being true next time. And so our goal is to get bigger. And every regional bank CEO who's paying attention is roughly thinking along the same lines. And so this would seem to support that same idea that you really want to be where the money flows to when this stuff happens, because if it doesn't, then you are borrowing from the FHLB. You're having to become much more aggressive on pricing for deposits to refill these gaps. I think it's being discussed among the Fed and others, how they make borrowing from the discount window less of a stigma, which maybe they'll have some success with. But the easier answer if you're a bank CEO is just get bigger.
Yeah.
All right. Should we move on to our question? I have a good one for you this week.
Yeah, sure.
Okay. All right. So why don't we have a national fintech charter? And the context for my question, as anyone listening probably can guess, is that this whole mess with Synapse and Evolve Bank and banking as a service absolutely melting to the ground right now, all of it sort of presupposes that banking as a service is the only way that we can allow non-bank technology companies to offer banking services. But of course, that's not true. And there are other geographies, other more civilized places in the world where such charters exist at a national level. In the US, we have state-level examples of interesting, novel, little narrow banking charters, or sort of funky payment company charters, or charters for crypto companies. Yep. We have examples of this at a state level. We do not have such a thing at a national level. Why the hell not, Kiah Haslett?
Yeah, it's funny because, so let me tell you a story about something that didn't happen. You are not the first person to come up with this. All the VCs on Twitter are also not the first people to come up with this.
No.
In December 2016, so almost 10 years ago, the OCC published a white paper called Exploring Special Purpose National Bank Charter for Fintech Companies. And in that paper, they made this argument that like their chartering authority would include issuing a national bank charter to fintech companies. And it was kind of like, sorry, because this is going to devolve into legal stuff really quickly. It was based on their theory that a lot of these fintechs are involved with like the business of banking, even if they don't quote unquote take deposits, if that makes sense. And so you can think of like payments and some other aspects. It just wasn't going to really focus on deposit taking. And so
deposit taking
or
would
lending.
still be...
You could do lending, you do payments, you just can't really do deposit taking. And so maybe this isn't all banking of a service, but whatever. So they put this out, and then in 2017, 2018, 2019, they start trying to like be like, hey, fintechs, apply to us, OCC, for this special bank fintech charter. And some of the state banking agencies, so like I think the New York DFS got involved, as well as the CSBS, said, not so fast, OCC. And they said that the OCC's charter, which was granted them by Congress and allows them to charter banks for a national banking charter, stipulates that in order to grant a charter, you have to take deposits. And the OCC does not have the authority to give a charter to a company that does not take deposits. And so there was this like whole thing happened. So there's 2 court cases. The OCC loses against New York in the first case. And so they appeal it. A lot of the OCC comptrollers, so there's 4 different comptrollers across 2 different presidential administrations that also support this. So this is actually something that OCC ideologically seems to want to do.
Yeah.
But what happens is when they lose the case, they kind of end up dropping this. They just don't believe, and they don't believe they can win in a court with the argument that their chartering authority allows them to grant fintech charters. And so the national fintech charter dies. It dies in 2020.
Yeah.
And it's so funny because I don't know, I think about how, this kind of happened. And, for a hot second, we lived in a world where this was possible. And then it was actually pretty firmly decided no.
Yeah.
And then it seems like then fintech people realize, hey, wouldn't it be great if there was a fintech charter? It seems like two ships passed each other in the night and you just missed the door on why we don't have this. And the whole discussion and the whole debate and the whole court case, where were the fintechs saying, hey, it would actually be really useful if we had this. And then now, 4 years later from this decision, we live in a world where we don't have a national fintech charter. And yet I still see people writing about how we should have one.
Yes.
And it's funny because you texted me once that we should have a national fintech charter. And I had to respond back being like, I can't tell if you know about the 2019 court case.
At the time, I didn't.
You don't know about it. So,
yep. I did not.
And I think it's interesting because it when you write a story, when you talk about something that doesn't happen and doesn't exist, how do you communicate to someone this is actually a really important part of our history and industry?
Yeah.
And it kind of shapes today the world that we live in and the values and what was more important, this chartering authority, which I can just feel everyone their eyes glazing over talking about the OCC's ability to charter non-depositories. So yeah, we don't have a fintech charter. This is why it's actually pretty recent history and we are still dealing with some of the fallout of it.
Well, so the irony of this is 2 parts, right? One is that going back to what we were talking about with these old laws like the Electronic Funds Transfer Act that maybe didn't anticipate how the future would unfold.
Yeah.
It's not like Congress gave its authority to the OCC 10 years ago, right? That is a very old law that probably did not anticipate some of the challenges that we are dealing with today. So I always find it a little troubling when people are like, well, legally you're not allowed to do that because of this law that was written when there were no airplanes. You're like, okay, well, maybe we can calm down that and not totally rely on that, even though it does seem like it was a pretty open and shut legal argument. I get a little frustrated when the legal argument relies strictly on precedents and the letter of the law, not the spirit of the law and the problems we're trying to solve today. So that's a little ironic and a bit annoying. The second part, though, that's interesting is, to your point, the OCC basically said, look, we can draw a distinction between different types of financial services providers that provide value to companies and the associated safety and soundness risks of those different activities. And so deposits, for lots of good reasons, presents its own whole profile of safety and soundness risks that we want to be very careful with. So if you want to accept deposits, you have to be a bank. You have to go through the whole process. Obviously, we've talked before about the de novo process and how it's become more difficult and more onerous and why there's not a lot of new banks being. However, not everyone who wants to offer some type of financial services, payments, lending, what have you, necessarily needs to do that. So maybe we should have different types of charters that enable for those activities, and we can kind of separate those things out. And obviously, our legal argument was, no, you can only issue charters if they take deposits. Okay, well, that's kind of silly. And the reason it's silly and a little bit ironic that the states were making that argument, as you point out, is that the states do the exact same thing that the OCC was trying to do. They issue specific types of licenses and charters to non-bank companies to do things like payments. We have money transmission licenses. We have lending licenses. We have all kinds of other abilities for you to be regulated at a state level to do financial services things that don't require you to get a full state banking charter. And so it's strange that banks the state level regulators would be fine with non-financial services companies doing that and banks still continuing to sort of be on a different track. But then when the Federal Reserve, or when the OCC rather, wants to, enable this new charter, these new types of, federal charters, the states are opposed to that. I mean, I have a hard time parsing the logic of that without coming to the conclusion that the states just didn't really want the federal government to be involved in this. Is that a fair reading?
I think that that's a reasonable interpretation, that this is about power. This is about who has the power to do what.
Yes.
And so the states are in a position where different states can authorize their DFSs to permit different permits or different charters. That is how the power structure works to grant these charters. And to think this is a regulatory advantage, right? This is something that makes the state attractive to a certain type of company. It gets a certain type of business. They want, the DFS wants to be supervising more banks or more companies, probably not less banks or less companies. And so it is probably that they would view a national fintech charter that covered payments and lending as being directly competitive to their, regulatory oversight interests.
Yeah.
And, I also think just make that argument.
Right.
I think that the OCC would probably be an equally good regulator for a fintech relative to any state in the nation. And I also think that unfortunately, this is a decision that was made for reasons that don't really seem to be in consumers' best interest. And we now live in a world where people are asking, where is the oversight of fintechs? And there doesn't seem to be a authority that has oversight of fintechs and their actions and their ability to manage payments or whatever.
Yeah.
And so it seems like we got nothing out of this, that consumers got nothing. And so to say great, I'm glad that we figured out what the OCC's charter does and doesn't allow them to issue on. And I'm glad that we answered that important legal question. But I think there's some other questions that we've left to the side when we just figured out that the OCC does not have its current authority and would need to get authority from Congress to do this.
I totally, completely agree. I always am troubled when these things result in sort of a narrow win for one side, but consumers and the industry overall sort of ends up losing.
At what cost?
Yeah, it's not my favorite. Well, I'm going to dig into this more. May write a piece about this in the future. Okay, I'll do my best to articulate that argument. Kiah, we just have a couple minutes left.
I know.
So I'm going to ask you to confine your rant to a very, very tight, 2 to 3 minutes.
Okay.
But I'm not going to sign off without letting Kiah Haslett go off. So go off, Kiah Haslett.
There's been a lot to be frustrated about on Twitter recently, and I know Twitter's not real world, but I am so sick of. So I'm a banking reporter who has to cover fintech now, which means that I have to expose myself to.
You get to cover fintech. You get to cover it. It's amazing.
I have to. I have to. I read a lot more about fintech and VC types than I maybe did a year ago, and I am really, really sick of fintech founders and VC types publicly indicating how ignorant they were about the banking industry, which is the space they ostensibly claimed to disrupt.
Yes.
And I have no idea how much hubris you have to have if you want to disrupt banking and you do not understand what I would consider basic banking concepts. And I feel really bad for everyone who's involved in the painful and sad fintech bankruptcy case. But if you thought FDIC insurance would cover the fact that you don't have access to your money because one of your key partners who facilitated money movement and disintermediation is in bankruptcy, I can't help you.
Yes.
And I can also, I have no patience. You should not be in this industry if you do not understand this industry. And I get that this stuff is really boring. I get you think banks are boring. And I would just really encourage you to not mess around with banks then. Because if you don't want to know about the history, if you don't want to learn about the law, if you don't want to learn about how the charter works, if you don't want to learn how FDIC insurance works, you don't need to work in banking. There's just a lot of other spaces that are less regulated and could benefit from financial, better user experience or some type of account or whatever value these fintechs claim to bring to the industry. But I just don't need the lack of curiosity and the deeply unserious approach that then is shown so painfully when something bad happens. If you don't want to do this, if you don't want to learn about it, don't be in this space. And I also get that there's like this like, hashtag not all fintechs response, but I also think that's deeply unserious and irresponsible. I hope that other fintechs that did take learning about banking seriously are offended by some of these fintech founders and VCs not knowing regular stuff about the industry. And like, I don't want to make it personal, but like, I mean, I've got screenshots. I make fun of some of these guys on Twitter, right? Like there's a VC who got, 16,000 views talking about how there needs to be a national license for banking as a service. And I was like, bro, where were you in 2019? Like, pay attention or shut your mouth, So that's my rant.
That's a good one. I very much agree. If you're not into bank nerd stuff, well, first, you're not listening to this podcast. And second, go work in a different industry. Like AI is hot. Go screw around with AI stuff. Don't work in financial services if you can't. Think about worst case scenarios. Think about strategies to manage the risk of worst case scenarios and learn your history about how all this stuff works, because for the most part, it works the way it does for very good reasons. So, Kiah, that was a magnificent rant. We will let you go, but look forward to doing this again next month. And as always, thank you for nerding out with me.
All right, thanks. Have a good rest of your day.
You too.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.